International Business Machines, otherwise known as IBM, ticker symbol IBM, their stock is down over 30% in the past 5 years, down over 22% year to date, and down over 30% from the recent high of around $171 per share, currently trading for around $120 per share. But with a dividend yield of over 5% and a plan to acquire Red Hat in 2019 for future growth, does IBM have what it takes to turn things around and become a good stock to invest in long term, or is it just another trap waiting to snatch up any unsuspecting investors? Let's find out. What's up everybody, my name is Ala and welcome to my world of stocks. So the way we're going to do this is we're going to talk a little bit about their business, the Red Hat acquisition, we'll take a look at the stock, the dividend, the balance sheet. I'll be giving my opinion throughout all these different sections, and then we'll end the video with my overall opinion on everything. So starting with their business, IBM is mostly an IT company that offers both hardware and software solutions to its customers, most of which are businesses that operate in a variety of different markets. And IBM offers them expertise in a variety of different services to help their business operate more strategically, efficiently, and competitively. This ranges from services in analytics, artificial intelligence, cybersecurity, blockchain, finance, transactions, and of course the almighty cloud, which IBM offers as both public and private cloud services in what they call the hybrid cloud, which we'll talk a little bit more about in just a second. Now, another thing that IBM is known for is their very popular cognitive computing platform named Watson, which you've probably heard of because it was featured on Jeopardy, where it beat previous champions like Brad Rutter and Ken Jennings and took the $1 million prize. Now, Watson was named after IBM's first CEO, Thomas Watson, and the easiest way to describe it is that it's a supercomputer that can interact with both computers and even humans to answer questions in natural language, which makes it obvious why it would be featured on something like Jeopardy! So it's almost like Siri or Google, but on steroids, and its ultimate purpose is to assist humans in information-intensive fields like medicine and healthcare, telecommunications, financial services, weather forecasting, and even government. But it's also being applied to more random fields like fashion design. But getting back to the hybrid cloud, this is where the Red Hat acquisition matters the most. But we'll talk about Red Hat a little later in the video. First, I want to explain what the hybrid cloud is, and that's essentially cloud services that are offered on both on-site and off-site locations. See, despite the almighty cloud being the huge buzzword these days, most businesses out there still use traditional data storage methods. In fact, IBM claims that enterprises are only around 10 to 20% transitioned into the cloud. So IBM basically comes in and helps these customers either transition their data and processes to the cloud, or gives them a hybrid offering, letting them use a combination of traditional or private cloud storage and services and public cloud storage and services. And while that may lead customers to signing up for Amazon's or Microsoft's cloud services, IBM has the opportunity right there and then to convince customers to go all in on IBM's platform and services instead, like IBM's Cloud Private and IBM Cloud, which is the public version. Okay, now before we take a look at how they're performing and what their future looks like, let's first take a look at IBM stock. They currently trade for around $120 per share, and they're down over 30% in the past 5 years and down over 20% year to date. That performance does improve over the past decade thanks to a very strong rally in the first 4 to 5 years, but it's been trending downward ever since, and mostly since 2013. On the bright side, this does make their PE ratio much more attractive at under 20 trailing, but even better forward at a very low PE ratio of less than 9 according to Yahoo Finance estimates. They're also trading closer to their 52-week low rather than their high, and they're also trading lower than their 50 and 200-day moving averages at the time of this recording. Okay, so why then has the stock been performing so poorly? Well, that really leads us to IBM's performance. Now, this next part is going to sound a little scary, and for someone like me who, I consider myself a little bit more of a growth investor rather than a value investor, I like to mix it up and kind of mix and match a little bit as well, but I do consider myself a little bit more of a growth investor. Well, this next part is absolutely frightening to someone like me. See, up until the end of last year, IBM went through 22 straight quarters of revenue decline year over year. That is insane, guys. 22 straight quarters. And really the reason for this is because IBM has been accused of just not really being innovative enough. Their legacy hardware and software just isn't selling well, it's not performing well, and so customer demand has really just been kind of trending downward. So that leads us to their current state and their future potential. Now, in their last 4 quarters, IBM did finally start to turn things around after reporting an increase in revenue. In fact, unadjusted revenue year over year jumped 4% in Q4 of 2017, it went up 5% in Q1 of 2018, and it went up another 4% in Q2 of 2018. However, this last quarter saw them return to revenue declines after posting a very disappointing drop in revenue of 2% in Q3 of 2018. Still, this remains a profitable company that brought in non-GAAP EPS of $3.42, which is up 5%, and non-GAAP net income of $3.1 billion, which is up 3%, along with a pretty nice gross profit margin that isn't too far away from 50%. Those numbers do get worse, however, on a GAAP basis, where net income is actually down 1% year over year. Either way, with IBM in terms of performance, you ultimately get a mixed bag without enough consistent growth. See, IBM lumps a bunch of their different high growth parts of their business together in what they call strategic imperatives. And this includes cloud computing, mobile, cybersecurity, and analytics. And lately they were seeing a lot of progress there, especially in the previous quarter, because they were able to bring in over half of their total revenue from that strategic imperatives group, which came in at 50.5%. And that's a huge deal because that's where you're going to see the most of IBM's growth. And this latest quarter, they reported that revenue from that group over the trailing 12 months came in at almost $40 billion, which is up 13% year over year. But I couldn't find the revenue for the group in this quarter's report until I later read on the Motley Fool that it came in at $9.3 billion, which is up 7% year over year, but it's still down 8% quarter over quarter, and it dropped to less than half of their revenue at 49%. Now, I know what you're saying, that's just a small drop in the proportion from 50.5% to 49.5%. It's just 1 percentage point, not really a big deal. But the problem is that that's the section where we're supposed to be seeing high growth for IBM. And while it did grow year over year, it still dropped quarter over quarter and it shrunk in the proportion, and now it's less than half of their revenue. So that's a big deal because even if it had stayed relatively flat, that wouldn't be a good thing. We want that to be growing and we want that to be a higher percentage of their revenue. That really tells me that even though it's practically half of their revenue and they still saw growth year over year, yet they still saw a decline in their total revenue for the quarter, down 2%. That means that there's other parts to IBM's business that is hurting them, and we don't want those other parts to be half of their revenue or more. We want that other high growth section to be in higher proportion, and we want it to be growing substantially. So really moving forward, there's 3 primary things that bullish investors on IBM are really focused on. Now, one of those is their growth potential in those high growth areas like cloud, analytical, AI, blockchain services, things like that. And then the other is their dividends. Okay, they have really nice dividends, so that's another focus. And then number 3 is their transition away from those legacy products that aren't performing well. So breaking down that first point of growth potential, and especially in the cloud, IBM is making a move there in their acquisition of Red Hat for a whopping $33 billion. And if you've never heard of Red Hat before, they're an open source software company that specializes in software solutions for the enterprise. They're famous for using Linux in their Red Hat Enterprise Linux software, and they've achieved tremendous growth in cloud computing. In fact, they claim to be the world's leading provider of open source cloud software. And you might be wondering, well, if a company is using open source software, how does Red Hat really benefit too much from that? Well, it's because they offer their expertise and their services, their IT services, right? So they offer that, and there's a lot of demand for that, because if you have your entire business running on some open source software, whether it's Linux or something else, you're gonna need some expertise to help you when something goes wrong, and that's where Red Hat comes in, and they're seeing a lot of demand there. In fact, just this past quarter, Red Hat achieved revenue growth of about 14% year over year. Although GAAP net income and EPS saw a decline of around 11%, but non-GAAP net income and EPS saw an increase of around 13% and 10% respectively. Either way, Red Hat is clearly an IT company that is growing at a much faster rate than IBM, and investors are hoping that it will give IBM a little bit of a boost that they desperately need. But critics from the bearish camp say that IBM overpaid for Red Hat, given that Red Hat's price was down almost 15% in October and down over 30% from their August high when IBM offered them a pretty generous $190 per share versus their price at that time, which was around $116 per share. Either way, Red Hat shareholders and regulators still need to approve the deal, and technically IBM could still back out of the deal if they pay a pretty hefty price. Now don't quote me on this, but I read somewhere that they would just have to pay like $1 billion, which is kind of a lot of money, but they would have to pay like $1 billion and they could actually back out of the deal. Now, you might be thinking, well, it's not likely that they would back out, but if you look at Red Hat's share price, they're still trading for $177 versus what they were offered at $190. So, investors of Red Hat are still kind of skeptical that this deal could actually go through. So they're not really willing to pay a lot more than what they're currently trading for, which is around $177 per share, which I find pretty interesting. Either way, the deal is not expected to go through until mid to late 2019. Now, my personal opinion on this is that it was a necessary move because IBM is trying to compete in a market that is flooded with these huge companies like Amazon, Microsoft, Google, and so IBM needs something to help them out, so they kind of needed to make this acquisition. Now, it is true that they're paying a very large premium for it, but I think that IBM really sees it as let's scoop them up now before some other giant company comes in and takes Red Hat before we get a chance to acquire them. Okay, now let's move on to point number 2, which is that growing dividend. Now, investors are worried about this acquisition of Red Hat because that's $33 billion in a combination of cash and some debt. And so they're worried that that will affect the dividend. And we'll get into that in a second, but first let's take a look at that dividend. Now, thanks to their poor price performance, the yield is mouth-watering right now at over 5% with a payout of over $6 per share, and they have a very reasonable payout ratio that is under 50%. But when looking at their years of growth, I think Seeking Alpha actually has this wrong because they show here 19 years, but it should actually be 23 years according to the earnings report this last quarter. And that's extremely impressive, and it's only 2 years shy of being considered a dividend aristocrat for IBM. Now, despite already having a very high yield, their 5-year growth rate is still in the double digits at over 12%, so just from a dividend standpoint, IBM looks extremely attractive. So is the Red Hat deal a threat to all of these dividends? Well, IBM confidently says no. They look at this deal as actually accelerating their revenue, gross margin, and free cash flow growth within a year of closing the deal. And even if we look at what kind of cash IBM is bringing in, their trailing 12 months of free cash flow is practically double what the dividend is costing them. They will, however, suspend their share buyback program through 2020 and 2021, which they've been pretty aggressive with lately, as you can see on this chart here. But suspending that program for a couple years will help generate cash for the deal. On the bright side, they did say that they still had $1.4 billion left in their share buyback program as of the end of September, so that should help ease the pain a little bit. And moving on to the last point, this is something that I haven't really seen too many reports on, but IBM is actually, they're currently selling off legacy parts of their business that are not performing well, which not only helps them with the transition that we talked about earlier, but it also helps them raise some cash for that Red Hat deal. Here you can see a list of those applications being sold to some Indian IT company called HCL, but that will reportedly raise close to $2 billion that can be used to pay off some of the debt that they will need to use to finance the Red Hat deal. Not to mention that IBM performs best when they can sell packages of software and services to customers, but these applications have reportedly been selling more as standalone products and hurting IBM's growth. And speaking of debt, IBM's balance sheet isn't really all that great, so it makes sense to sell some of these legacy products that aren't performing well. Cash is at over $11 billion, raising their current assets to over $48 billion, but current liabilities are also pretty high at over $36 billion, while total assets are at $121 billion versus total liabilities at $102 billion. Generally, I like to see a 2-to-1 ratio or better in both current and total ratios, but IBM misses the mark here and is playing a little dangerously with this acquisition, considering all the fear going around about corporate debt and the next recession. So in conclusion, I'm left with a few different thoughts. Now, on one hand, IBM is this company that has been performing very poorly for several years and has only recently kind of started to rebound a little bit, but this last quarter was another disappointment, seeing a decline in revenue and missing analyst estimates. On the other hand, I like the fact that IBM is selling off parts of their legacy business and moving more towards, focusing more attention on their growth drivers like artificial intelligence, cybersecurity, blockchain, and of course cloud computing, which is evident by their push to acquire Red Hat. And I kind of like that deal because Red Hat is this, IT expert in cloud computing, and IBM is also an IT expert. So I think there's going to be a lot of synergy there, and I think that they will kind of feed off of each other and help each other grow. However, the argument that IBM overpaid for Red Hat, I think is a very valid argument, especially when you consider how volatile the market has been lately. Chances are that Red Hat would actually be trading at a much lower price. I really do get the feeling that IBM kind of overpaid at this point, but on the other hand, it was a necessary move. They have to start trying to grow. They got to innovate. They got to make some moves if they're going to stay relevant. So with those potential growth drivers, along with that really nice dividend, I love that dividend. It's a perfect dividend. As a dividend growth investor, that dividend looks great. The only problem is that you're not going to get growth out of the company. That's what I'm afraid of. So, we really have to see how much growth they get from Red Hat if they can really start to turn things around at a business level. So for me personally, I'm not picking up IBM yet, because I would really like to see the company actually turn things around. There's a lot of heavy competition in some of the areas where they operate. I really don't like going against Amazon, Microsoft, Google, things like that. So I really just want to see them kind of turn things around a little bit first. I want to see how they perform. And then once I kind of start to see that, I think then I might start considering to pick them up. Having said that, with all the volatility in the market right now, this is a stock that the share price could definitely drop some more. And if it does, that dividend yield is only going to get even more and more attractive. So at some point, I might want to jump in just because of that dividend, but I do not want to sacrifice a poor performing stock and pretty much lose all of those gains from the dividend, right? So I do want to see some recovery at the business level, and then I'll consider jumping in. At the moment, there's still a lot of really good companies out there. And because of this market volatility, we always keep coming back to this. A lot of these companies are actually trading at pretty good valuations right now. So I feel that there's a lot of options out there. I don't really need to limit myself with IBM, but it's definitely on my mind. I'm absolutely tracking IBM, and I will see how this deal goes next year. And I'll definitely follow up with you guys in future videos. But who cares what I think, guys? It matters what you think. So let me know in the comment section. Are you bullish, bearish, or neutral on IBM stock? How do you feel about them? Do you agree or disagree with anything I said? Are you picking up any IBM stock yourselves? I'd love to read all about it. On Instagram, I actually posted a poll on IBM stock. I usually do this for the different stocks that we talk about on YouTube. And I put buy or sell, and I had 43 different people vote on it, and 20 voted buy and 23 voted sell on IBM stock. So it was actually right there. It was pretty even, which just shows, how controversial IBM stock is right now. A lot of people kind of debating about it. A lot of bulls, a lot of bears. So anyway, I just thought that was kind of interesting. But anyway, thank you guys for watching. I really hope you enjoyed the video, and I'll catch you guys in the next one. Have a wonderful day. Bye-bye.